Trying to get a confirmation so I can stop the transcript. Stop. Okay. All right. So, like I was saying, investment basically is when you commit a fund for capital appreciation, right? That is basically when what investment is all about. So, commitment of a fund now for the purpose of capital appreciation or generation of income. So that is what investment is. Like you have 10,000 today, tomorrow your 10,000 turn to 12,000. That is an investment. So basically, it is for capital appreciation or to guard against inflation. So why do we invest? So this is a general a past questions of Olowe. He asked this question a lot. Why do we invest? So just know about 10 reasons. I think what he asked us was to list 10 reasons why we invest. So please, this is Olowe past question. Number one reason why you invest is for capital appreciation, to make sure that your money keep growing, to guard against inflation, for tax savings. Like there are some investment that you can do, like e.g., instead of you to allow all your salary to be subject to payee, you can decide to do pension fund, right? What's it called? Life assurance premium, whereby any premium you pay for that life assurance will reduce your current payee for you. So you can invest also for tax savings. Then there are some government instrument that you invest on that you get zero tax on them. All right. Then self-disciplines too, maybe for savings culture, for retirement planning, achieving financial goals, uh, financial security and independence, edge against uncertainty, diversification, and financial security. So these are some of the 10 reasons why you need to invest. Please know this, know at least 10. There are more than this actually, but I just listed just 10 for us for our information. Then what are the types of investments? So generally speaking, there are two types of investments, right? Generally speaking, there are two types of investments. We have what is known as a fixed income investment, and we have variable income investment. So what we talk about fixed income investments, fixed income investment, these are the categories of investment that provide regular returns for you. Like what you'll be getting as returns is constant, right? It is constant. And most of these fixed investments, they are very safe and they are less volatile when compared to equity. You know, the difference between equity and fixed return is that under fixed return, your income is constant, e.g., you have bond. If it is 10% coupon, that coupon will be constant. But equity, your returns is variables in the sense that it is when profit is declared that you will be entitled to dividend. So that's different. So fixed returns mean your investment is secured, right? So these are some of the characteristics of fixed returns investment. Number one is a regular income. That your interest or returns is constant. You get it on regular basis. Then capital preservations is also another reasons too. It is less risky. Then lower volatility. So most of these fixed returns investment are low risk investment. Then maturity. So you know that at a particular day in the future, you'll be able to get your money back. Okay, at an agreed amount. That's maturity. Then credit risk. So for credit risk is also very low here when it comes to fixed income instruments. E.g., if you purchase any government treasury bill on government bond, even if that country collapse, your money, you can get your money back. International, what's it called, body, IMF can come to the rescue and pay you back. So when you purchase anything like Euro bond or government bond or government treasuries, it's as good as no interest. You go and sleep. So even if the country collapse, like the country was declared bank, I don't think it's possible for a country to be declared bank. If anything happens to the country that the country cannot pay you, you are still backed up by World Bank and IMF. Those one will still come to the rescue. So anything like government instrument, their credit risk is very, very low. Then interest risk too. This is also very guaranteed. You get your interest as at when due. So what are the types of fixed income investments? What are the types of fixed income investments? So Professor Lowe gave us just three of them. The first ones is known as your savings account. So whatever money you have in your savings account, they are your fixed income investment. Then you have your term deposit or fixed deposit. If you decide to do a term deposit or fixed deposit, they are also a fixed income investment. Then we have the money market security. So when we say money market from the word money market shows that they are usually a short term. hello, you know, we have what is called capital market and money market. So this money market is basically for short-term instruments, right? It's for short-term instruments. Why capital market? That one is for long time. So this money market instrument itself is grouped into two. It's grouped into two. We have what is known as the non-government securities. This one, when you say non-government, it's not government is not involved. It is just between private entities, like private companies, correct? That is what is known as the government securities. Under non-government securities, these are the one arrangement between two companies. One of them is your CP. Your CP is known as your commercial paper. So I will explain what commercial paper is all about soon. Then the second one is known as your bill of exchange. So these two falls under non-government securities because they are not backed up by any government. They are usually between two private entities. Then under the government, we have what is known as bills, notes, and bonds. Okay, these are the one we have under government: bills, notes, and bonds. So when we say CP, so let's talk about CP. So under the non-government, we have two, CP and bill of exchange. So let's talk about CP. So when we say CP is usually a short time unsecured promise. It is unsecured. Hello, who is that? Hello, who be that? So can that person mute, please? Okay. All right. So
can you pass like that?
Who is the person? No, I'm looking for the person so I can mute the person. Sorry, don't be out. Okay, that's you're a Dane. Okay, I'm meeting you.
Sorry, sir.
Yeah, what happened when traffic, Abby? Can you pass like this? I hope they don't scratch your car, sir. Okay, all right. So let's discuss. So when we say CP now, commercial paper, they are usually unsecured promissory notes. So this one basically is between companies. But before any companies can issue a CP, that company must be very creditworthiness. So that whenever you issue a CP now, everybody will come and buy it from you. If company like Guinness issue a CP, people will rush it because Guinness, they believe that they are creditworthiness, right? Or if someone like Dangote now issue a CP, they will rush it because Dangote it will not run away, it will pay. So before you can issue a CP, your creditworthiness must be very sound, high. Because if you issue it and your creditworthiness is not sound, nobody will buy your CP. You will buy it yourself. So that is basically CP. So CP are usually discounted and the face value will be paid on maturity. CP are issued at a discounted value and the face value is usually paid on maturity. So that is exactly what CP is all about. It is usually issued at a discounted value and you get your face value back at maturity. And note that all CP are usually less than 180 days. So all your CP, they are usually less than 180 days. And if any CP will be above 180 days, then you need the approval of your SEC, the Security and Exchange Commission. Okay, please take note of any CP that will go above 180 days require the approval of SEC. All right, so that's just what CP is all about. So let me just save us all these stories too. Let me save us all these stories because I need to wrap up from this chapter as soon as possible. So we have two types of commercial paper. This one like a directly placed commercial paper. So this one are usually directly by the companies to investor without any intermediary. Like this one directly, this one, it is a company that is selling it directly, but it is very rare. Most CPs are usually through an agent. But just note that there is also something called directly placed CP. This is where Guinness on their own, they are using selling it directly on their own without going through any stockbroker or any dealers. They are selling it themselves directly. That is what is known as a directly placed CP. Okay. Then the second one is dealer placed CP. So this dealer placed CP is the CP that a company is selling through a third party, like a broker or dealers. They are the one that is usually done in the second. You know, there is a difference between primary market and secondary market. So when we talk about, let me explain this thing with you with a joke. When we say primary market, they are the market where virgin instruments are being sold. Something that is virgin, not touched by anybody. You get them from primary. But when you go to secondary, you are buying what is this virgin already at the secondary market. I hope you know the difference now.
Who tell you say they never touch virgin? You better stop that.
I don't know what you are saying, but my people, I hope you guys understand my analysis of this. That is how I was taught, and all the sticks since today I was taught like that. I hope you guys understand the meaning of what I just said now. Hello, leave governor alone. I want you guys to talk. Hello, my people.
Confirm.
Confirm. So primary market, that is where you get your virgin instrument, something that has not been touched, brand new, sha. That's from primary market. Then the one that has been disvirgin, you buy them from secondary, like e.g. if Zenith Bank is selling shares now, and you want to buy Zenith Bank shares yourself, you fill a form. That is primary market. You are buying directly from Zenith Bank. But if after you have bought Zenith Bank shares, a year or 2 years later, you now want to sell Zenith Bank share, you cannot sell it at primary market. So you have to go to secondary market through all these agents to sell. That's the difference between the two. But if you are the one buying the shares, brand new, untouched, virgin, that's primary. But once it has been touched, you have touched it, you don't use them for how many years? You now want to resell it. Then you go to secondary market. So that's just the meaning of primary and secondary market. If you don't understand it like that, then I don't know how I can explain it again. Okay. Okay. So the dealer plays commercial paper. Now, these are the commercial paper that I normally sell through a broker, not directly from the company. Okay, it's different from the directly placed CP, which are being sold directly by the company. This one are been sold through a broker. That's why we call them dealer placed instrument. Then the third one is asset based. So this one are usually secured by your receivables or any other financial assets. I'm sure you guys know what is a financial assets, right? So those one are the one that is called asset based. Then the last one is bank paper. When bank are the one, this one usually backed up by a bank. It is usually secured by a bank. So these are the 4 types of CP. In case Professor Lowe asks us, explain the 4 types of commercial paper. Know that they are directly placed commercial paper, dealer placed commercial paper, asset backed commercial paper, and bank paper. So what are the benefits? So let me save us all this and move on to other areas. Okay, I'm saving us all these things. So I'm saving us all this. So there are still other stories here too. Now, so let's discuss bill of exchange now. So bill of exchange, basically it is a document that is used both in international and domestic trade, right? To ensure that there is a payment for goods and services. So from the definition of bill of exchange, which is in the Bill of Exchange Act, right? It is a written unconditional order by one party directing another party to pay a specific amount to a third party or to the bearer of the bill, either on demand or at a specified date. So usually an unconditional order that once a bill is issued, it can be cancelled, right? It is usually an unconditional order. So there are some characteristics of bill of exchange. Number one is it is an unconditional order, meaning that it is an order that you have to obey regardless, and it will specify the amount that you must pay. It is usually a fixed amount, and the 2 parties involved will be stated on the bills. Okay, so that's just, let me move on. All right, so we have various types of bill of exchange, which I think we did this one in our, what's it called? International banking at 1st semester. We have not payable on demand, we have bill at sight, and all of them. So let me just skip them and move on to other areas. So you can read more on those ones too. But I don't know if Professor will go deep on all these things. So these are just my own notes. I formed them. Okay. I don't think he will go deeper and ask most of these details that you have here, but it's just for your information's sake. You read and that's all. So let me move on now to other area. So I'm leaving the non-government securities now. Let's discuss government security. Let's discuss government security. So I'm leaving the non-government securities now. Let's discuss government security. So when we say government security, the first one we have is bills. Bills is the first one. So your bills always have a maturity of less than a year. Example of your bills are your treasury bills, which are usually issued by CBN. Okay, or we have a bill which are usually issued by CBN. Most treasury bills, they are 91 days. They always have 91 days maturity. Most treasury bills. So in case you have any free money that you don't know, like you have like 500K you are keeping in the bank, my brother and sister, you are very wrong though. That 500K or whatever you have in the bank can conveniently earn you up to, I think you can get up to 17 or 18% interest, right? So if you keep money in the bank, you are very, very wrong. So please don't do that again. Apologies to the bankers here because they will not like what I'm saying, but that's just the truth. So please don't keep any free money in the bank. Use it to earn some investment income. Treasury bill is the easiest way you can earn money on, and it doesn't require too much formalities. Okay, it's just 90 days and you cash your money and you move on. So that's for treasury bill. Then there is a note too. This notes always have less than a year. Okay, I mean it's usually between 1 year to 10 years. Then there is government bond, which we have more than 10 years maturity. But now the DMO, there is a body called DMO in Nigeria. They've started issuing 5 years bond now in Nigeria. Some bonds are 2 years, some bonds are 5 years because they are looking for money. So they've started issuing those kind of bonds now in Nigeria. So please just take note of. It's not that all bonds are 10 years and above. Now we started having 5 years bond. I think they issued one last month, Abi. Yeah. So there are 3 types of bonds, right? The first one is your state bond or municipal bond. So the difference is that all the ones that are called state bond or municipal bond, they are exempted from tax. Okay, they are exempted from tax. They are exempted from tax. Just take note of that. In case they ask us to define which bond is exempted from tax, just know that it is state or municipal bond. They are exempted from tax. Then there is a general purpose bond. So this one is usually based on the capacity to repay back. Then the third one is revenue bond. This bond is tied to a particular project. It is that project that will pay back the bond holder. Okay, revenue bond is usually tied to a project, and it is the project that will pay back the bond holder. That's why it is called revenue bond. It is the income from that project that will pay back the bond holder. So then that's for that. So, all right. So you can read up on the advantage of bond and this other risk associated with bond. You can read up on that since you guys have this material. So you can read up on all these other ones later. All right. So then, okay, let me also explain what is known as a zero coupon bond. So when we talk about zero coupon bond, don't think everything is zero. Don't think it is zero. So when it's talked about zero coupon, what it means is that there will not be any interest that you'll be getting. You won't be getting any interest. But the only compensation you have when you go for a zero coupon bond is that bond will be issued to you initially at a discount. Then when you are now redeeming it back, you redeem it at the face value. That's the only, in fact, the only benefits you can take note of. The only compensation or the only benefit that a bond holder derive from the zero coupon bond is that this is usually issued at a discount and redeem at par. Imagine you buying something for 800 naira and they are paying you back 1,000 naira. So that's the only incentive on zero coupon bond. Okay. So then when we talk about preference share, preference shares are those shares that have a preferential treatment over ordinary shares. So they always rank above ordinary shares, right? They have preferential treatment over ordinary shares. So their own returns is known as what is called preference dividend. And there are about 4 types of preference share. The 2 types are based on the categories, while the remaining 2 types are based on how the interest is paid. So when we talk about redeemable preference shares, so these redeemable preference shares are those preference shares that can be buy back in the future, right? You can buy them back in the future. So you can pay now, then in 5 years' time, you convert them back you take them back from the holder. Yeah, take your money and go. That's why they call them redeemable. The preference shares that can be buy or redeem back in the future. Then, so based on the financial reporting, IAS 1, those of us that are into IFRS space, when we have a redeemable preference share, should be treated as a loan, right? You treat it as your loan. That's based on the provisions of IAS 1. I've forgotten the paragraph. I will have stated it now. So, but irredeemable preference shares, these irredeemable preference shares are those preference shares that cannot be bought back again. So they are not redeemable. So under IFRS, your redeemable preference share should be taken as your equity. So you take it as equity. So when you are presenting your financial statement, you must show your redeemable preference share from irredeemable preference shares, because redeemable is like a loan, while irredeemable is your debt instrument. So irredeemable is your equity, sorry. Now let's look at how the payment pattern is paid. So when we talk about, there is what is called cumulative and non-cumulative. So when we talk about non-cumulative preference dividend, so under this non-cumulative, now your preference dividend, the interest they are usually fixed, right? Your interest payments are usually fixed on them, maybe 20% preference share. That means every year you get 20%. So if peradventure a particular year the company does not have money to pay. They are broke. So what it means is that if it is a non-cumulative now, any arrears of preference dividend that cannot be paid for a particular year will be forfeited. That's why they call it non-cumulative. Any arrears of preference dividend that cannot be paid for a particular year will be forfeited. That's why it is non-cumulative. But the one that is cumulative, it is cumulative because any arrears of unpaid dividend for the previous year can still be carried forward to other years. That is why it is called cumulative. So you can carry forward arrears of unpaid preference dividend. Then what about convertible? So this convertible, they are those ones that has a features of both debt and equity. So whenever you issue any convertible shares, they always have features of debt and equity. So initially, when you issue a convertible, they are your debt instrument. Then later on, they will be converted to equity. So they are normally called an embedded instruments, or you call them convertible instruments. So examples of your convertible instruments or embedded instruments are your convertible bond, convertible preference shares. So let's leave. That's all about fixed security. I believe I've been able to analyze fixed income security for us very well. So let's move on to variable security instruments. So guys, are you guys following me, or am I too fast? Hello, are we following me, or am I too fast? I'm moving on to variables now.
We are following.
Okay, so in case you discover that I'm too fast, maybe not no verse, because we have to cover what I need to cover so that I can hand over to BVM to continue. So, but this class is recorded. It will be on YouTube by God's grace tomorrow morning. So you guys have the opportunity to go to YouTube and download it. I mean, and watch. If you want to download it, download, or you go and watch it on YouTube tomorrow morning. All right, so let's discuss variable security instruments. So when we say variables, what variable simply means that your income is not regular and it is usually not within your control. Okay. Number two things, income is not regular and it is usually within your control. E.g., if examples are your ordinary share. If you purchase ordinary shares, you cannot be the one that will tell the company you must pay me dividend. No, it is the company that will decide. If they declare a profit, they will pay. And if they don't declare a profit, they will not pay you. Try again later. So that is why it is called variable instrument, because the dividend is usually based on the performance of the company, which is usually not within the control of the shareholders. So that's why it is called variable. So your returns is usually based on the performance of the company, which is not within your own control. So if they like, they will pay you. If they like, they will not pay you. So there is nothing you can do. So examples are your ordinary shares, number one. Number two is your real estate investment. So these are the two major examples for the variables income in security instruments. So you can just read more on all these things again, then, so that when you read more on them, you should have a better understanding. So let me leave. So with this now, I believe that I have done justice to the introduction that Professor Lowe taught us on day one of his class. So with this, I believe that I've been able to do justice to that. So let's now proceed to valuation now. So this is the area that I need to spend much time tonight, and probably where I will be stopping tonight. So but let's proceed to valuation. So what is a valuation itself? Let's define valuation. So valuation basically is when you are trying to know the worth of an asset or of an instrument or of a company. Whatever thing you want to value is that thing that you want to know the worth of. You want to know the worth of a company or of an asset or of an instrument. That is valuation. How much does this thing worth? That is what we are simply doing is called valuation. So there are some basic concepts that you need to understand under valuation. There are some basic concepts that you need to understand. So the first one is known as your intrinsic value. Like I explained the last time that when we say intrinsic, what intrinsic simply means is that value within, okay? Value that is usually determined within the organization. That is your intrinsic value, value within or inherent value, something that is usually determined within the company. That is what is called intrinsic value, something that is determined within the company. That is intrinsic. So it's usually based on your fundamental analysis, right, on your past record. Then the second one is the market price. So market price is the price at which an instrument or something is traded in the market, right? This is usually determined by the forces of your demand and supply. Okay. Then fair value. There is a difference between market price and fair value. Note, so they are very similar, but they are not entirely the same. When we talk about fair value, this fair value basically there is something called open market here. That is a market where there is a knowledgeable willing buyer or knowledgeable willing seller. That is a fair value. A knowledgeable willing buyer or knowledgeable willing seller must be there. Let me try to differentiate between fair value and market value with this example now. If you want to buy a phone in Lagos now, you want to know the true cost of a phone. The best place to go is what is called Computer Village, because you will see hundreds of people selling the same phone. So from there, you will know the price at which that phone was. You go to shop A, shop B, shop C, shop D. Most of them will almost have similar price. That is fair value, because you are the market, an unbiased market where there is homogeneous information, right? You have knowledgeable willing buyer, knowledgeable willing seller. That's why the fair value. But a market value is usually location based. The market value of a phone in Yaba will be different from the market value of a phone in Ikeja. So it is location based. That is why your fair value is very similar, but that location is just different between your fair value and market value. Okay. So which other one? Then let me explain what is known as the net realizable value, because Professor Lowe asked us to define it in the class, I remember. So net realizable value basically is your selling price less estimated cost of sales. That is your net realizable value. Your selling price, net estimated cost of sales. Then another one that you should know very well is the one that is called breakup value. So this breakup value, it is usually applicable whenever a company is going through a distress. Whenever the going concern of a company is no longer guaranteed, then that is when you have to activate what is called breakup value. So breakup value should be activated when the going concern of a company is no longer assured. But if a company is still under a going concern, then you are going to use your fair value. But once the going concern of a company is under threat, there is nothing fair in that company again, then you have to use what is called a breakup value. So another name for breakup value is false sales value. Another name for breakup value is false sales value. So let's just take it like that. Now, the last one is known as the residual value. So this is the whatever thing that is left after the useful life of an asset. That's known as residual. Whatever that is left is like a salvage value. What after the useful life of an asset. So I now wrote in something that the value of any asset is a function of the future cash flow discounted at the current discount rate. The discount rate is a function of your patient, inflation, and uncertainty. So let me, I'm taking too much time. Oh, this is almost 10, my God. So, okay, let me see, what's the agenda like? Okay, introduction, I'm done. This one is done. Okay, so this valuation, I can take this till 11. Let's see. I may not reach 11, maybe by 10:30, I'll just hand over to BPM. But let's see. So, like I said, the value of a company is a function of your patient, inflation, and uncertainty. So let's define them one by one. I said it the last time that for patient now, patient talks about how long do you want to keep an instrument, right? How long does an investment want to keep an instrument? Because the longer the instrument, the higher the interest rate, right? While the shorter the instrument, the shorter the interest rate. So that's what we call patience. So if an instrument is for 10 years, the interest rate for 10 years instrument will be higher for an instrument that is just for 5 years. So that's the deal. The interest rate for an instrument that is 10 years will be much higher than an instrument that is just probably 5 years. That is what patience is talking about. The inflation too is also very key under instrument, because your inflation talks about the purchasing power of your future cash flow. So you should know how to determine this real nominal and whatever here. So your nominal discount rate is just your real discount rate plus your expected inflation rate. So if you want to calculate it, you just multiply the two, you get your nominal. Okay. So that is exactly. Then the third one is your uncertainty. Like if I'm keeping my money with you for too long, then there are a lot of uncertainty. So there under uncertainty, we have two types of analysis there. There is something that is called systematic risk and unsystematic risk. So systematic risk are those ones that uh that are not within my control, right? Okay, like general market risk, e.g., inflation in the market or maybe natural disaster. Those ones are systematic risk. So you can only hedge your systematic risk through CAPIM. I think we should look at CAPIM in details on Wednesday. Okay. Then the unsystematic risk are those ones that are as a result of the company's internal affairs. Maybe you have a bad management, you have a poor staff morale, or you have something going on with you internally, internal issue. Just say internal issue. That's what we call systematic risk. So for systematic risk, you have to use your portfolio diversification to analyze them. So I've talked about these three. So let's just move on. So these questions too, I'll always solve it for us. I don't know. Let me quickly revise these questions for us. So if you check this now, bond A, invest 940 today and pay back 1,000 after a year. Then bond B, invest 850 today and pay back 1,000 after 2 years. So that's it. So calculate the respective interest rate and what is the forward rate. So respective interest rate is just your future value is equal to present value plus 1 over n. So for bond A, this 1,000 that you are paying back after a year is your future value. While this 940 that you are investing today is your present value. And it's after a year. So by the time you apply this formula, your compound interest formula, it will give us 6.38% as our rate. Then you do the same thing for bond B. Bond B means you are investing 850 and you are collecting 1,000. So that means 1,000 is your future value, 850 is your present value. So and the number of years is 2 years. So once you do that, you get about cumulative interest rate, that comes about 8.47%, right? That's the interest. Then you can calculate the total returns too. Like bond A, the total return is 6.38, which is equivalent to what we got here. Okay. Point B, the total return is 17.64. Note that this 17.64 is the returns for 2 years. Okay. If you want to use a lazy method, just say divided by 2. However, there is a way whereby you can calculate the actual returns for year 1 and actual returns for year 2 without being lazy. Okay, how? So just put this formula. 1 plus your TR, total returns, is equal to 1 plus your RS, that's your actual returns, plus 1 plus forward rate. So here we want to calculate forward rate. So the total return is this 17.64. That's 1 plus 17.64 is equal to the spot rate is the rate for 1 year, which is this 6.38. That's our spot rate. Then you can calculate your forward rate. So here now, if you do this now, your forward rate comes to about 10.5% per annum. That's your forward rate. Okay. So that was the area that Professor Lowe taught us on day 1 before he left. Now, Dr. Jobu now came in to start the following week. So he taught us this. So I don't need to repeat all this thing again because I've already defined valuation of that. So Dr. Jobu now taught us valuation of bond as a topic. So this is, please, guys, anything I'm about to teach now, these are the area that I'm done with the introductory aspect of Dr. Professor Lowe. Now, I'm moving on to Dr. Jobo core area now. So anything I'm teaching, they are likely exam question on Saturday. Okay, whatever thing I'll be saying now that are the area that Dr. Jobo taught us, these are the likely exam question on Saturday under Dr. Ojobo's part. Please take notes. So valuation, we have already defined that it is a process of estimating the worth of an asset, right, or a security. Then why do we do valuation? Why? He gave us 2 reasons why. Number 1 is that to know whether or not to invest. Number 2, to know whether to buy or sell an instrument. Those are the 2 reasons why he gave us for why we should do a valuation. So definition of terms, right? So we have the first one, which is coupon. Coupon is usually your interest rate that it is usually paid annually or semi annually. So coupon is usually paid annually or semi-annually. Okay, then yield. Yield is what you are expecting from the instrument. That's whatever you as an investor are expecting from the instrument. That's not as your yield. Now, there are two types of yield. We have what is known as a approximate yield, and the second one is known as your current yield. So current yield only focus on your current earning, while the approximate yield look at over the lifespan of the instruments. That's for approximate yield. Then maturity value, basically, this is what you get once an instrument matured. And this maturity value could either be at premium, par, or discount. When we say at par simply means that if you invest 100 today and you are getting 100 in the next 5 years, that's at par. You are getting the same par value. Okay. Then at premium means you are getting something higher than what you have invested. E.g., you invest 100 today, you are getting 105. That's at premium. Then at discount means you are getting lower than the amount you have invested. That's at discount. E.g., you invested 100 today, but you are getting 90. That's at discount. So note the premium, discount, and par value. It is very, very important. Then maturity is the tenor, the end. Then face value is the current worth of the instrument. While indenture is an agreement that contains all the terms and conditions pertaining to a security. That is known as what? Indenture. It contains all the terms and conditions pertaining to a what? Security. So how do you know? Please, are you guys following me based on this thing that Dr. Ojogbo taught us? Everything I'm saying now, there are potential exam questions. Maybe we can learn from how it sets network, it set QT for us. You can see that in that QT is set, everything is taught us came out. It just add them to different questions. E.g., question number 5A, you will see A, network, B, decision, C, which other topic did you teach yourself? Inventory. That was how he twisted everything. So I won't be surprised if he decided to twist his question to with everything. So meaning don't ever look anything. He might decide to also twist them the way he did for QT. That he just twisted everything for us. Okay, we had network in almost all the questions. So please don't underestimate anything that Dr. Ojogbo taught us. So, and that is the area that, like I said, Dr. Ojogbo and Dr. Hammer, Professor Olowe, may God guide us in that. Okay. So, how to determine if asset is properly priced or valued? So, you conduct two analyses. The first one is the fundamental analysis. So, when we talk about fundamental analysis, under fundamental analysis, you consider basically the internal value of an asset, which is your intrinsic value. That's what you do under your fundamental analysis. So it's always within. You don't go outside. You analyze it within you. That's fundamental. It is within the company that you do the analysis from. Then when we now take about technical analysis, this is where you start to look at what is happening in the market. You focus on the market trend, right? That is what you do under technical analysis. Now, when we talk about valuation process, it told us that there are three valuation process, right? Like if you want to value a company now, you have to follow through 3 stages. The first one is you do your economic analysis. You analyze the economy as a whole. Your macro economic variable like your GDP, inflation rate, exchange rate, CPI, consumer purchasing power. You try to do all those analysis. This is also known as your country analysis. It's known as country analysis. That's what you do first of all. So when you have done all this analysis, the next thing now, you now do industry analysis. So this industry analysis basically focus on that industry itself that you want to analyze. It focus on the industry that you want to analyze. That's what you do under industry analysis. Then the third one is known as your company analysis. So that company that you want to analyze, you will now go in the company and analyze the company. So that's what you do under these 3 analysis. So economy is the country analysis. Industry is the industry that the country operates. Why company is that particular company that you want to analyze. So that's just for that. Then, okay, we also have a question like, now the decision rule for bond is very easy in the sense that if a bond is selling for 1,000 naira, and the price of that bond, you got about 800 naira. As an investor, you have to buy. Okay, so if the price of the bond is lower than the current fair value of the bond, then the current market value of the bond, then you should buy. But if the current market value of the bond is lower and the price of the bond is higher, then don't buy. So that's just a decision rule. So I use these questions to analyze them. So go through them. Okay. I promise you that I'm going to go fast. Let me just go through it again. So look at it. XYZ currently price a bond for 2,000. That is the price of the bond. And the bond market value is 3,000. ABC Limited, which is to invest, kindly advise ABC. If you are ABC, what will you do? You will rush the bond at like Indomie. Because if something market value is 3,000 and they want to sell it for what? 2,000. So you rush it and buy because it is cheaper. Okay. Then look at this second question now. Where the value of the bond is greater than the price. So the same thing I've explained, right? So, hello guys. Are we following me? It's been long that I heard from anybody else. Are you guys following me?
Yes, we are.
Okay, so I am gradually, thank you. I am moving on into core valuation now. So let's look at the questions now. We want to calculate the value of a bond. So if you are told to calculate value of a bond, just know that value of a bond is the summation of two things. Okay, the first thing is the total present value of your coupon plus the present value of your redemption. So the value of a bond is your PV of coupon plus PV of redemption amount. That is the value of a bond. So without me revealing the solution, can you guys quickly calculate this and give me the answer? No. What is the value of this bond? Anybody? Can you do that in 2 minutes for me? I won't say anything, no. Just do it for me in 2 minutes. Can somebody tell me the value of this bond? Don't look at your book. The solution is in our book. Please don't look at it. Just quickly calculate it with your calculator. But what is the value of this bond? Everybody. What is the value of this bond? Just quickly, you should be fast now. I mean, we should be able to get this in 2 minutes. Okay, just use your discounted DCF to calculate the total interest. Then do your coupon at 5 years, right? That's all. Do your coupon at the end of year 5, and that is all you need to do. What is the value of the bond, though? Who has the answer now? Who has the answer, please? I want to twist it again to another thing. This question. I want to twist it to another thing again. Does anybody have the answer? My 2 minutes is almost up. Oh yeah. My 2 minutes. 1,189.
1,000.
Okay. Oh yeah. Let me twist it now. Give me the value of the bond. If this coupon of 15% is paid semi-annually. Fast. If the coupon is paid semi-annually, what is the value of the bond? If coupon is paid semi-annually, everybody should participate. So I'm not saying you, but God is saying you. I'm not saying you, but God is saying you. If you don't know it, tell me you don't know it so that we can do it together. So everybody should participate. Give me the value of the bond if the coupon is semi-annually. Oh yeah.
Kazim,
Yes, sir.
I just want to try 1772.
One.
1772. I just pressed it on calculator, so I'm not sure.
1772. Okay, let me
Yes.
write answer now. You are APC.
I'm Labour Party.
Okay, Labour Party. 1772. Another party again. Who else? What is the value of the bond? Coupon is semi-annually.
1309.
Oga party will you are APC Abi 1309. Oh yeah, let me take one more answer, then we'll move on. One more answer, and we'll move on. Value of the bond, interest is paid semi-annually. Oh yeah.
1257. 1257.
Which party, sir? PDP.
APC.
1, 2. Come on.
5, 7.
Three scholar, 3 different answer. Wala ti ṣẹlẹ̀.
Sorry, take out APC. There's an error there.
Okay, APC, what is your answer? 3 people, 3 different answer. Oh, wala ti ṣẹlẹ̀ báyìí. Anyway, we will solve it together now. We will know which party gave us the right answer. APC, what is your new answer? You want to tell me? Can I continue? Can I quickly solve it now? Can we give up and let's solve it? Can we solve it together now, guys? Hello?
Hold on a bit.
Oh yeah. Don't give up. Oh yeah, do. How far? Oh yeah.
Casey.
Yes, sir.
Casey.
Yes, sir. I'm with you. Governor, I'm with you.
Check your WhatsApp. Check WhatsApp.
My WhatsApp, Abi. Okay. Let me stop sharing so I can share it. It's on my laptop.
Okay. Okay.
I get Cham now. This thing you're asking me for, I get. Don't worry, I'll give you.
No, before you go talk on now.
And I say I get them. I'm not saying what you're asking for now.
Okay.
Don't worry.
No,
after the class, the class, I'll give you.
Okay.
That one no be wahala. I know what no be wahala. Yeah, bro.
1004.
1004.
Yeah.
Is that PDP or which party?
Update APC.
Labour Party.
Labour Party.
Governor.
That is like
if you are sharing money, give me too.
Governor, I'm scared. Really, I'm actually scared for us.
Then say I will give you. I mean, like Kasim say I will give you. That you are saying governor, you are sharing money.
People they share money.
You know, Governor. Do you know why?
Labour Party.
Do you know why I'm scared? Do you know why I'm actually scared, Governor, for these investments, right? Why I'm scared is that I have 3 scholars here, and they got 3 answers. 3 scholars, 3 answers. Wala ti ṣẹlẹ̀ báyìí. Okay, guys, I think because the answer is not right. No, okay. Because of that now, because there is a conflict. Let's solve it together now. Let's solve it together. So permit me to. Yes, sir. I'm done taking answer. I want to solve it now. Okay. Which your party? Let me give you. NMPP.
Labour Party. Labour Party.
You said what?
964.6.
9.6.
Yeah,
Okay, so let me
964.6.
thank you, sir. Let me change this question back to the way it was before. This one was like this. So I've copied this one down now. There is a wahala now. So I will let me quickly solve it since all of us did not align. Let me solve this together. So this is the question we want to solve this. So we said semi-annually. Now solution. So when you have any question on semi-annually, right? Your coupon will be actual coupon divided by 2. Or you can see the number of time in a year. Okay, number of time in a number of payments in a year. I'm looking for English that you guys will get, or payment in a year. So what it means is that your coupon will be 15 divided by 2, which is 7.5% is your coupon. Then your duration,
15.
your duration will be actual duration multiplied by number of payments in a year. Sorry, actual duration multiplied by number of payments in a year. So it is for how many years? 5. That's 5 times 2, which is what? 10 years. Abi, do you get it now? Your IRR or yield is same thing as coupon. That will be 10 divided by 2. So which is equal to what? 5. So just calculate it with this matrix. You should get your answer. Can I move on now, or we should finish it together? Do you get me? Hello? Can I move on, or want us to finish it together?
Please, let's finish it together.
Yeah, but I've given you the metrics. That's the metrics you need. Year cash flow, DCF. DCF will not be at 5% now. It will be at 5%. At 5%. Where's my at 5%? Then we have my PV. So year, it will be 1 to 10. Okay. What's our coupon now? Our coupon is 7.5% of how much? 7.5% multiplied by 1,000. This is how much, please? This is how much? This should be how much?
75.
75. So put this one. Okay. Let me bring it down. Year 1 to 10. So this is 75. So year 10, you bring the 1,000 back. Oh yeah, can you do this year for 5% for 10 years for me? Cumulative this year 5% for 10 years. Emma, use your powerful calculator. Those with fake calculator should not talk. They know themselves. 25K and still no good. Emma, do it for us. Tell us the answer.
It's 7.7217.
7 point what?
7.7217.
Okay, it's original calculator, Abi.
Yeah, no, it's not your own. No, this one is machine, German machine. German machine.
Yeah. Multiply it by 75. Give me the Emma, please help me validate this number. I trust Emma more.
It's true. Confirm.
How much? Oh yeah, how much? Everything, how much?
579. 579.1.3.
579.13. Oh yeah, do this year for 10 years at 5% for me. Year 10 at 5%, how much?
Okay. That's 1.05 raised to power minus 10. That's 0.6139.
0.6139. How much?
Yes, multiply.
This should be 613.9.
Yes.
Oh yeah. How much? What's the answer? What's the fair value of the bond now?
Plus 579.1.
Eh?
1193.
Talogba.
Nobody.
1193. APC.
Point what? 1193. Wow, everybody show. It's a pity actually. So you can see that, guys, we have worked. And most of Olowe question, most of his past question, they are semi-annually. So if people need to go and practice this When we get to convexity and more, I will do semi-annually too for us there. But most of his past questions are semi-annually. But do we understand the way I solve it now? Who doesn't understand it, please? Do you guys understand the way I solved it now? I need feedback. Hello, what are the
Yes,
ladies?
yes.
Ladies
Yes,
have not
the
been
mistake I
talking.
made was that I used the full coupon, the 150
Well,
instead of 75.
well, where are the ladies? They have not been talking. Kí ló ń ṣẹlẹ̀? Ṣé pressure ti wà ní? Ẹ sọ̀rọ̀ now.
What is soon?
Ladies, ẹ sọ̀rọ̀. You guys, ladies have not been talking. Yeah? Okay. I have not even started at all. And okay. I think I'm getting there.
I beat all the ladies on this platform.
You want to evict them? Hey, that is if you be able to write your exam on Saturday. I cannot guarantee that. Because they will use their power for you.
So
you can evict them, but I can't guarantee if
you
you
want
be able
them
to
to
write that
be here
exam.
without. You want them to be here without talking.
You cannot threaten that if you evict them and you don't write the exam, because which one is worse off? They will just use ladies. They will use ladies' power for you. On the day of the exam day, you wake up 11 a.m.
I will send Ojogo to them.
I said on the day of the exam, you will wake up at 11 a.m. in the morning.
Once I wake up 11 a.m., I will just call Ojogo to make sure he's in the hall.
What will you do? Okay, let's continue.
I'll be writing -20. Any lady that talks.
All right, let's move on. So, guys, this one too is similar to the one we just solved now. Okay, it's similar to the one we just solved. Or I want you guys to master it. Can you guys quickly give me this one too? Hello. Hello.
Yes, we are here. We are here. Oh.
Hello.
I think it's your network. Oh. We are here. We can hear you.
Hello. My network. Oh. Can you guys hear me?
We can hear you. We can hear you.
Okay. Can you guys quickly give me these ones too? If this our returns is semi-annually, can you do that quickly? I want ladies to talk now. Guys should not talk. Ladies, it is me and you now. I want to talk to my ladies now. Can you give me this answer if the interest is paid per annually? At least if what you can master to write is semi-annually, I'll be so glad. Oh yeah, what is the price of this bond if interest is paid? This R is your coupon. Oh. Let me make it easy. Coupon. Ladies and those that have not been talking, it is you I want your voice now. I'm giving you just 2 minutes to do it. Ladies and those that have not been talking, give me the price of this bond if interest is paid semi-annually. Fast. 2 minutes. This is 2023. By 2025, we'll stop. And we'll move on. If it's semi-annually, you guys will understand tonight. You know, I do. Ladies, don't fall my hand, Ejo.
Ladies will and they alone by.
They are there, they will talk. I trust my ladies.
859.53.
That should be too big. About the mathematics, that should be too big.
859.53.
Yeah.
Let's say you are a Labour Party.
859.53.
Oh yeah, another lady too should talk. Another answer.
Seconded 859.53.
I'm not saying you should second it now. You do your own now. Why are you seconding?
This one a man.
Governor, leave me.
Oh, Ima, you've done it. It's correct, have you?
Oh
yeah, let's move on. Otilo. Let's move on. So you go and complete it on your own. 859.53 is the answer. Final answer. Oh yeah, let's move on. So this one's too the same thing too we solve, right? So let's move on. Now, hello. Now I want to explain these two things. The formula that they gave us in the class is wrong for this. So let's get the right formula now. The formula that doctor gave us for approximate yield to maturity is the formula for yield to maturity. So when we talk about yield, there are 3 different types of yield. We have current yield, we have approximate yield to maturity, and we have yield to maturity. That your yield to maturity is known as your precise yield or actual yield. Your yield to maturity is known as your precise yield or actual yield. So when we say current yield, so this is your yield, actual yield based on the existing returns. So the formula for current yield is your interest divided by your market price. Your coupon or interest, same thing, or coupon divided by market price. That's your current yield. Okay. Then approximate yield to maturity. Your formula is C plus F minus P. C is your coupon. Fair value is the market price minus P. That's the price of the bond divided by N. Then into F plus P divided by what? 2. So that is the formula for your approximate yield to maturity. Then the third one, which is the actual or precise yield. That is where you will use IRR. But in the class, Dr. Ojogbo went to use IRR for approximate yield to maturity. Elsanio, it is wrong. Please, you use IRR for yield to maturity. But if it is approximate yield to maturity, this is the formula that you use. I just hope in the exam, it will not ask us to calculate approximate yield. I went ahead to use IRR Markings guide. That is when I go fight more. If it's coming rubbish, I go defend, I go fight. Because that formula is wrong. I just hope so. And I pray it won't be like that. Okay. So,
So are you supposed to do the correct thing or the wrong thing?
You do the correct things now. Why must you?
Is that the way it's something for you? Is that the way it's something for you in class?
Exam before some people will go
is
do
that the way
something
it's something
else.
for you in class? If it's one that said the question, I would rather solve it the way you solve it too.
You will just put approximate maturity / yield to maturity.
They are not the same now. Even if you check all our textbooks now, you see the right formula there. They're not the same.
Know.
You know the right thing, Abi. So why do you want to do wrong thing in the exam?
Okay.
So I think we should do the right things, right? So I will support us doing the right thing. And if someone is trying to penalize us for doing the right thing, then we have every means to defend. BBM, get ready, Lo. I will sign out for you. You'll come up on board in 15 minutes time. BBM, are you on this call, sir?
All right.
Hello, BBM.
Yeah,
okay. Yeah, you come up in 15 minutes time. I'll just anywhere I stop in 15 minutes, I'll just stop. Okay, so I think now I've explained current yield, approximate yield, and yield to maturity. So that has been taken note, Abi. We've taken note of that. So if you are to calculate yield to maturity, note that you are going to use your IRR to calculate. So your IRR. What is IRR? IRR is a point where your NPV is equal to 0. That is IRR. IRR is a point where your NPV is 0. That's your IRR. Sorry, just give me a minute. Let me quickly switch off something here that is disturbing me. Yeah, I'm back. So, yeah, I'm back. IRR is a point where your NPV is equal to 0. So look at these questions now. Calculate the yield to maturity of the following bonds. So what we did was to calculate both the positive NPV and negative NPV. So our yield to maturity is at our IRR. Okay, so I'm sure that you guys still know how to calculate your IRR. So with this now, moving on to call provisions now. I'm moving on to call provisions. Call provision is when you want to call back your bond before it expired, right? So there are 3 types of call provisions. The first one is a freely callable bond. So this freely callable bond is the one that you just need to give between 30 to 60 days notice and you can call it back. That's for freely callable bond. You can call the bond back. So provided that you give 30 to 60 days notice, then the bond can be called, can be recalled. Then the second one is your deferred callable bond. So this deferred callable bond is the one that you can call back, but not immediately, but it will be at a specified date in the future. That's why I call it deferred. You can call it back at a specified date in the future. Then the third one is uncallable bond. So this type of bond, you cannot recall it again. It is gone. Put in law, subsidy is gone, it's gone. You can't recall it again forever and ever. That's why they call it uncallable bond. So please, let's know the formula for the bond. Let's know the formula for the call provision. So the formula is so under this callable bond, the only thing they will ask you to calculate is the yield to call. If you are to call the bond, how much is going to be your yield to call the bond? So that is the only thing they will ask you. So and your yield to call is your returns plus your price to call minus price of the bond divided by NC. NC is your number of years you want to call, okay, which is usually lesser than the duration of the bond. And your NC, your PC is your price to call. So e.g., look at these questions now. They gave us the value of a bond as 1,000, which is the nominal value. They gave us the PD, which is the current price of the bond, as 950. They said that they can call this bond at a price of 1150. So why do normally? So whenever you are recalling a bond, they will entice you with higher value. That is the incentive for call. You get more money. Then the return is 10%. The year is 5 years, and the year to call is 3 years. Meaning, instead of you to wait for 5 years, they say, yeah, in 3 years, take your bond back. Okay, so your yield to call is equal to your return. Your return is this 100, which is your 10% of the face value. Then plus your price to call is the price that they want you to call it back. Minus your PD. Your PD is the value of the bond, which is what? Your PD is the value of the bond, which is 950. Then divided by the NC. NC is the year to call, which is what? 3. Then you now do the same thing. 1/2 into PC plus PD. So once you do this now, you'll be able to get your yield to call, which in this case is 15.87%. Okay. So let me take duration.
Kazim,
Yes, boss.
sorry.
Yeah.
So I want to I want to draw something to your attention. This formula for yield to call, do you know it's basically the same thing with approximate yield to maturity? It's just
the same
that
thing. The only thing is
it's the same thing.
FC,
yeah, it's just that
FC and FP, you change it.
Exactly.
This guy, and he crowd formula go. If you look at this formula approximately to maturity,
it's the same.
F just replace this F with your RC, PC, and replace this P is the same P. Is your price of the bond now. Your P is P. Just replace your F.
Is the same. It's just
Just
that
replace
F that
your
to call.
Ima, one should be scared of you. You don't cram. So just replace this PV with your price and you are good. Okay, so you are good. So that's so it's the same formula actually. Replace this PC with your, what is it called, your F, and you are good. The same thing with that one. All right, let me take duration and I will stop at duration. So when I come back on Wednesday, I'll just continue from compound instrument, right? The compound instrument. So let me just take duration and I'll stop here for tonight so that BBM can come on board. Please don't go. We are still here till 12. BBM is the one that will drive us since 12 a.m. Okay, so when we say duration, so you normally measure duration because of the risk attached to a bond, right? That is why you do the duration, so that it will tell you whether your bond is feasible or not, right? Based on the new duration. So we have a bond. They said calculate duration of the following bond. The face value is 1,000 and the price of the bond is 950. Yield to maturity is 12%. The coupon is 10 and number of years is 5. Please know in the exam, Ojogbo will not write it for us like this. So in the class, it's just writing it for us like this. So in the exam, they will write one grammar, ABC Limited, purchase also things for this data. They won't just write it straight. This one looks so straightforward though. But in the exam, it will be like a sentence, a story that they will write. So you are the one that will now need to pick out all these vitals one by one. Okay, so your coupon here is 10% of your face value, which is 1,000, right? So coupon is 100. Then, so once you know your coupon, just form your table. So it will be 100 for 5 years. Then in the year 5, you are redeeming the bond back at that face value of 1,000. Then, so since you are calculating your duration, and this one does not involve convexity, so what you would do basically is multiply your year by your cash flow. So you can see 1 times 100 is 100, 2 times 100, 200, 3 times 100, 300, like that. You multiply it. But if it was to be convexity, you will calculate the present value of this cash flow. You will now multiply the number of years by your cash, by your present value. Anyway, BBM will take care of that soon. So once you do this now, then you now do your DCF at the normal rate of 12%. Then you calculate your PV. So in this case, our total PV is what, 3837. So the duration of the bond is your total PV divided by the price of the bond. Did you give us price of the bond? I think no, Abi. Yeah, it gave us 950. But note that they may not give you the price of the bond. Sometimes you have to calculate this 950. So the meaning you calculate your total price of the bond, just like the way we've done before. So this question looks so straightforward because you are given the price of the bond. But in most cases, you may not be given the price of the bond, that you have to calculate it on your own. Okay. So let me stop here for today. Really, I don't even know I can even go far like this tonight because I'm not too strong. All right. Afoma, you raise your hand. Can you speak before I go?
Sorry.
I will still be on the call.
please.
I'm not going anywhere.
Okay. I don't know. I don't really get the difference between bond value and bond price. Can you help with that?
Bond price and the value. Now, okay, the value is usually given at the beginning, which is like your, what is it called? Your fair value, your face value. Okay, that's always given. But the pricing of the bond is your discounted cash flow plus your discounted redemption amount. That's pricing. Bond value is given at the beginning. Okay, it's given at the beginning when you are issuing, they will give you the value of the bond. It may be at par, at discount, or at whatever, which is same thing as your fair value. But the price of the bond is when you discount all your cash flow plus your returns. I don't know if that makes sense to you now.
Okay, it does. Thank you.
Yeah, so that's the difference between the two. So any questions for me before I change my mode now to students? Any questions for me, please? So if there are no questions for me, so I know where let me just start from next class here. So I know this is where I'm starting from. Next class is on the 18th of September. So I'm starting from 18th here. So I'll conclude all these things next week. If possible, there are a lot of past questions too that are here, which we are going to solve next time. But please don't miss it too because of that convertible. I'm taking convertible next time. Many people have issue with convertible security. So that is what we'll likely start from next class, convertible security. So please make sure you join us 9 p.m. next on Wednesday so that I don't mix my explanation on convertible. So this is where I'll be starting from on Wednesday. All right. BBM, I think you can take over now, sir.
All right. Thank you. Good evening,
Share your
everyone.
screen. Share your screen.
Yeah. Yeah, I'm putting it up already. Just confirm if you can see my screen. Hello.
I'm fine. You can
Yes,
see
We
it.
can see your screen.
yes, we can.
All right. So I think I'll probably be starting from where KC where he stopped. So briefly we'll be looking at this order we'll be looking at this evening. We'll go off. So it looks simple, but I mean a little bit complex. And after we solve for this, then we come in to solve it, assuming that the coupon is quoted semi-annually. Because Casey is actually right as regard what he saw, that there is tendency they may tweak it and give us and tell us that the coupon is quoted semi-annually. So it is important to know how to make use of that information, or sometimes it may be confusing. Okay, so now this is the question. It's on duration and convexity. So that's basically what we are solving for this evening. Duration and convexity. Okay, so BVN PLC has a 12% 1,000 naira bond with a 5-year lifespan, which is currently selling at this amount. I will calculate the duration and convexity. Before I go ahead, actually, this question is inside our notes. It's actually inside our notes. I'm coming. Let me see where it is particularly. But just that inside our notes, we are giving the yield to maturity. But in this question, we are not giving the yield to maturity. So that may be another poison that may be brought. So like they will give us a question and they won't tell us the yield to maturity, which is same thing as the IRR or the expected return. So in this question, we'll proceed to first of all get the expected return. In the class, I think it gave us, which happens to be 14% thereabouts. But yeah, we'll have to calculate it manually and see what it will be. But before we proceed, I mean, just to create a step-by-step. So we all know that the formula for duration is that's equals to PV of cash flow.
Governor, please check your WhatsApp. Governor, check your WhatsApp.
Divided by price of bonds. Okay. So, and like I've said, the first thing will be for us to find to determine the what's it called our IRR. And just to recall, our IRR is equals to our
sorry,
maturity.
BBM.
Yes.
BBM. Please, where did you get these questions from? Because this question has been circulating. I've received it from more than 5 people on my WhatsApp.
No. Essentially, this was coined from what they gave us in class. This one, we did it in class.
Okay, it's basically because many people have been sending it to me on WhatsApp. I don't really know where you got it from. That's why I'm asking. So this is basically class question.
Yes. But
Thank
just that,
you.
like in a way, I twisted it by not bringing the what's we called the yield to maturity, and also the fact that we'll be considering semi-annual coupon. Do you understand?
Okay, thank you.
So that's hold on. Let me just look for where it is inside our note. But we did it. I think it was the lawyer that took us or thereabouts. Okay, so yeah, under bond.
It's fine. Carry on. It's fine.
All right. So okay. Okay, so far to get our IRR now. I'm not sure if this typing is convenient for me, but let me see what I can do. Okay, so what is our what should we try it? What should we try it with? I mean, what should we
it's try and 5%. Let's start with 5%.
5%, okay. 5% and what?
Let's start with 5%, yes.
Yes, I've written 5%. 5% and what?
5 and
let's
15.
5% now. Then depending on what we get, whether it's a positive or negative,
if we give one
determine whether we increase or decrease the
All
rate.
right, God bless you. Depending on the first MPV, we tell you how to move for the second discount factor.
Increase or decrease rates. Yes.
Okay, yeah. I agree with you, but I think there's some people that are of the school of thought that whenever you want to calculate, you want to determine what your IRR is, they say you should always look for something within the coupon price, that the IRR is usually somewhere around the coupon price. So for instance, if I'm inside the exam hall and I'm to try something out, I'll use 10 and 15. That would be my first guess before I can now try anything. But let's proceed to.
In fact, that is Mr. Abbas' method, though.
Exactly.
Do something within. Yeah.
So do something within the coupon that has been given to you. So in this case, I would love to gamble 10 and 15. PV. Okay, so 0, 1, 2, 5, then we have 5. Okay, so we've been given the current price, which is 931. So that will be our initial costs, which is like the cost of the bond at the moment, which is 931.34. Okay, and permit me to do this on Excel, please. This is not really so we can be faster as well. Okay. Hold on. See, that's 10, then EV. See, at 15. Okay, so we have 931 points.
Can you enlarge your screen? Maybe zoom it, zoom that Excel sheet.
I'm so sorry. I'm used to a very small screen.
You never use your eyes do anything without it. Ask someone like Dero. You dare not look at this screen without glass.
Okay. Okay, so
yeah, my
from the
don't go. I can see it will continue.
Okay, so from the question,
I'm actually short-sighted, so I don't even have issues with this.
So from the question, what's our coupon? We have 12% at 1,000 naira. So the coupon is definitely 1,000 naira times 12%, which is 120. So the coupon is 120, and the value of the bond at the end of the year is 1,000. So I mean, we're not being told if it to be redeemed either at par, at discounts, or at premium. So since this question is silent as regard that, so it's usually best to assume that it's been redeemed at par, so which is 1,000. All right. So what is the for year one? The DCF is cost to brackets 1 plus. What is our R? At 10%, 0.1 raised to power minus 1. So this gives us this divided.
Oh, sorry, Israel raised hand. Israel, speak.
Oh, please go ahead.
Yeah,
Yes.
please. I just want to confirm something. That your formula that you use for the duration, can it really suffice? Like, can it work for the duration formula? That present value of cash flow divided by the
price of the bond.
Price of bond. Considering that
the time, I'll be multiplying it by time.
Multiplying by time, yes, exactly.
Okay. I don't know how best can I put that in English, because I didn't just want to type all the long formula. So I mean, essentially, it's the price of the PV of the cash flow after being multiplied by the time divided by the price of the bond after being multiplied by the price. So that's it essentially. But I'm just looking for a better way to simplify it rather than writing the full formula.
Okay, yeah. I think
that makes sense.
Yeah, I just mentioned this because based on this format as well, there is no we have considered time. I'm not sure whether I can send it where we have considered time on this format.
No, we are yet to, because we want to get our IRR first. So after getting our IRR, then that's when we'll go to the table to calculate our that we use to calculate the main duration and the convexity and all.
Okay, not this same annuity that you will use to get it.
No, not here. I'm not using it here, self. So I just I quoted the formula there. I'm not using it here.
That's fine. Thank you.
BBM.
Yes.
So for year 0.
Yeah.
Okay. I think you've corrected it.
Yes, I've made up it to that. Thank you.
Okay.
Yeah.
BBM.
Yes.
So it's not semi-annual. Are we not supposed to factor in that?
Okay, so what I said is that after solving for this, then we'll do semi-annual. Or do you want us to go into semi-annual straight?
No.
No.
Should we just do
first.
semi-annual then?
No, do annual first. We'll do semi-annual later. Even that complexity, you can even add 20 basis points, or let's do like Olowe this evening. Let's confuse. Let's just add everything.
To it, Abby. All right. No problem.
BBM. This
Yes.
annuity formula.
For
the
year
one of 1 to 5.
Kazim, people don't like you. Where were all these people when you were lecturing? Start Lomo, start the BBM.
Yeah.
It's not about that one, Joe. Hold on. Just a minute. 1 divided by. Hold on. This is not it.
Is 1 equal to 1 minus 1 minus 1 plus R.
1 minus 1.1 raised to power minus 5.
Divided by 0. All divided by R.
All divided by.
Yes, R.
I guess it's it.
Exactly.
All right.
Yes. No.
Yes. Make this negative. Okay, so we have 144 here. So let's do the same thing here at 15%. Okay. Okay. Okay, so we have this. Okay. Okay, so we now have a positive figure and a negative figure. So I think this is fine, and that validates the assumption. So rather than wasting time and all, so always starts by gambling with something within the coupon that has been given. So the IRR is usually somewhere around it, and usually, as a matter of fact, it's usually a bit higher than in most cases that may not be true, but usually it's even higher than the coupon. Because
hello,
yeah,
hello?
I can hear you.
Okay, please, that present value of 15%, can you do it again?
Present value of 15%.
Yeah, just do the multiplication again.
Okay, so this is the first one, year 0. So that's 1 plus R.
No, that's the point. Just the multiplication, how you get the PV.
Okay, the PV.
Yeah.
Can you see it?
Okay. Your cursor was initially on the PV of discount of 10%.
Oh, all right.
Thanks.
Yeah, you're welcome. So in getting the IRR now, so that's our lower rates, which is which is 10%. And what is the NPV of should I do this on Excel? Should I do this on Microsoft Word? I'm actually confused. So let's do it on Excel. Then NPV of the lower rates, which is equals to this, divided by NPV of lower rates, which is this, minus MPV of IR rates, which is this here. Let's move sky. Sorry. Okay. So multiply by higher rate, which is 15%, minus lower rate, which is 10%. So that gives us that's equals to this equals to this divided by this. Okay, and this gives us 5%. Yes.
Why not just say equal to?
I'm trying to break.
Okay, you want to break it down?
I'm trying to show it one by one so that everybody can see it. That's the thing. I don't want to just lump everything up. So that's what I'm trying to do actually.
Governor, we know that you sabi small Excel, so relax.
I don't want to do it one by one so that everybody can see what we are doing.
Okay, well, that's good.
Yes, sir.
I can't hear Fumi's voice tonight. What happened?
Okay, so then we have it should now be equals to this multiplied by multiplied by this.
Hope Fumi's mental health has not been punctured.
But Oga, leave her alone, leave her.
So which is now equals to this plus this. So with this, our interest, our IRR is 14%. Please do you understand? Don't mind the fact that I did it a bit dirty on Excel, but I just try as much as possible to make it, to break it down one after the other. Lower rate plus MPV of lower rate divided by MPV of lower rates minus MPV of higher rates multiplied by your higher rate minus lower rate. So our IRR happens to be 14%. So we may want to check from the example given to us in class, the one I was referring to. You see that Tolowe just gave us directly that our IRR is 14%. So just in case they didn't give us, there shouldn't be any panic. So this is the way we can get it by ourselves. So after this, we can now go ahead and now calculate what we are meant to calculate by preparing our table, whereby we'll have our T.
If not wickedness, so somebody expect me to first use IIR to get the YTM before I now start the question.
Don't be angry.
That's good. Those people, they want to finish up. They want to finish us. It's too much now. Within 2 hours.
But where is the time to be doing all this nonsense?
Exactly, Governor. The time is my challenge, honestly. The time is my challenge
now.
It's wickedness. Don't mind them.
Shebi na una thought say una want MSc.
Okay, so for us to calculate the table, so what is our cash flow? Our cash flow is still the same thing as we've used here. Our cash flow based on, the coupon multiplied by the face value of the bond, which is equals to 120. Okay, which is the same thing for all years. But at the 5th year, it will be redeemed. So meaning that we'll be having the redemption value plus the coupon. Yeah. So which gives us this. So this year at our IRR that we have here. So that's what we'll be using. So which should be what? Let me copy my formula here. Okay, so this is going to be I'm just going to be 14. So I'm using 14% approximation. I'm using 14% straight up. Okay, so we have
minus 14. Minus
exactly
14.
minus 1 rather. Okay, so let me drag this down and adjust my figures. minus 2, minus 3, minus 4, then minus 5. So we have our DCF. So what is the present value? Just multiply this by your DCF. Then you have this. Okay. Then our PVT, that's your present value multiplied by your T. Okay. So, and our PVT plus 1. That means what we've got here, our PVT multiplied by your T plus 1.
BBM.
Yes, sir.
I think you can try to break it down. Escape your formula first. Okay. Insert a column. Do T plus 1 first. Let my people see the breakdown. Let's do T plus 1 for them.
All right.
Do T plus 1. Yeah.
All right.
Bring that one. Yeah. Just do T plus 1. So tell them that plus 1, that was separate so that they will see it. T plus 1 alone first.
All right. That's noted. So our T plus 1. So this is essentially our T, then plus 1. So you do the same. So this gives us 2. So you do the same thing for year, which is your T plus another 1. So 3. And so on. You do the same thing for all years. So we have it like this. So this one is our PVT multiplied by T plus 1. So meaning this multiplied by this multiplied by this, and so on and so forth. So now say this is equals to this multiplied by this. So drawing this down, so we have this. So what is the sum of this? So this gives us 2608. How about this as well? This gives us this, and this gives us this. Okay, so these are the figures that we'll be needing in calculating our duration and convexity. And like I've said, based on the formula that I gave earlier for our duration, and Israel, that also made me use that formula, the PV of cash flow. So this is what I was referring to. I mean, based on this table, the PV of your cash flow, though, you know, the PV here, you are yet to adjust it for your T. Yeah. However, the was record. Oh, sorry, apologies. Oh, sorry, PVT. I mean PVT here. So your PVT divided by your PV. So and our PV is the price of the bond. So essentially, you are saying that our duration is equals to PVT divided by PV. Okay, so that gives us PVT divided by PV. So and that gives us our duration, which is approximately 4. Okay, so this is our duration. All right, so going forward to calculate our convexity, I believe we all still remember the formula for convexity. So the formula for convexity is, let me just write it out here. Okay. Convexity. I'm sure Casey already gave us all this formula, but just to bring this back to expression of our way. Okay, so the formula is 1 divided by 2 multiplied by 1 divided by PV multiplied by 1 divided by 1 plus KD, small letter here, raised to power 2, multiplied by your PVT. PVT T plus 1. Look for a better way to present it. Make this strong. That's great. Okay. So this is the formula for our convexity. essentially. So inserting it into what we already have here. So our convexity is equals to 1/2. So I will just be separating it by parcels so as to make it so as to break the formula down. So that's cater for our 1/2. Now 1/PV, 1 divided by what is our PV? This is our PV here. Oh, sorry. I missed that. 1 divided by PV. Okay. So the next one is 1 divided by 1 plus KD raised to power 2 plus 1 divided by 1 plus what is our KD? What is the cost of debt? Anybody? What is the cost of debt?
14%.
Exactly.
10%.
Thank you. 1.04. 0.14 rather. Raised to power 2. Okay. So that's to cater for that. Then we have multiplied by our PVT C plus 1. So which is this. So essentially we are multiplying all of this together to get our convexity. So this multiplied by this guy, multiplied by this guy, multiplied by this guy. So and we have our convexity to be 8.5. So just to provide some sort of clarification and little understanding as regard what all of these things mean, because I mean that these are many of these things actually make sense to me, because anything I'm being taught in class, if I cannot make sense of it, trust me, I don't really assimilate it and I struggle a lot to pick it. And that's where I do have issue with many lecturers, because if you can't really make what you are teaching, if you can't really make it relatable and make it make sense to me, I don't believe you are passing knowledge yet. So what duration what is actually focused on is that it measures the sensitivity of the bond's price to changes in interest rates. So essentially what this 8.5, or no, don't let us start from here. What this 4.0 means is that if there is a change in your interest rate by 1%, the price of your bond will change by 4 naira. That is what this convexity, that is what this duration, that is what it's in play. This is what it explains. However, convexity also explains the same thing, but it's, I mean, in a way, I feel like it's just like a refined duration. It's like you preparing or you estimating the worst case scenario of how your bond price can react to change in interest rates. So I feel that, it's just like for those that analyze markets, we have moving averages and we have estimated moving averages. They are all used to analyze the markets, but just that the interpretation given to one the same thing as the interpretation given to the other one, but just that they are just being used at different level of analysis, but they are both pointing at same direction and same thing. So what they are both trying to explain is that if there is a change in your interest rates by 1%, by how much will it have effect on the bond price? So it's a way of measuring risk. So portfolio managers, they use it and know that, so that they use it for forecasting, so that they will know that, CBN, they're having meeting today. They may most likely touch the interest rates, the MPR and everything. Assuming that they are changing, they are altering the MPR by 200 basis points. What would be the effect on our portfolio? And that's the reason why under this question, you always see them asking you that if there's a change by maybe like 200 basis points, 50 basis points, 100 basis points, what will happen? See what will happen. So that is they trying to practicalize it, that let's now say there is a change in the interest rate by 50 basis points. What will happen to the price of your bond? So in essence, that is what they are just trying to do. And that is how it makes sense to me and what we are trying to do and all. So I don't know if that makes sense. Hello.
Yeah, very well. It does. It does. Very well. Well done. Very well.
All right. All right. So like as Casey suggested, so that we should try to, because we're actually done with this, except we want to go ahead with the semi-annual coupon. But as Casey suggested, that we should try and factor the change in what was it called? Basis points. So I think let's use what basis point should we use? Let's suggest.
I use like 200 basis points.
Let me see how they used to coin that. Let me see how, I want to check how they used to coin that their statement as regards changing basis points, blah, blah, blah.
Yeah.
So I can quote it anyway. Ahead. They said, assume a change in basis points of, so assume a change in basis points.
No, assume a change in interest rates by 200 basis points.
Okay, a change in interest rates
by 200 basis points. Remember, Ojogbono teaches basis points, so now they allow teachers. So I take note.
So and I want to argue that we all understand the concept of basis points, how to calculate it and all. So this is how it works. You see, basis points, the way it's being is just to me is more of like jargons. They could have gone straight forward and say percentage, but it's just financial jargons. This is what it implies. If the CBN, if they say they are increasing interest rates by 100 basis points, they mean they are increasing interest rates by 0.1%. So 100 basis points means 0.1. 200 basis points means 0.2%. And 50 basis points means 0.05%. Does that make sense to us? So in this case now, so for you to know the basis, to convert this basis point to percentage, just divide it basically by 100, and that will give you whatever thing that it is. So in this case, we said we should assume that a change in interest rates by 200 basis points. So just as well, I explained the reason why we use duration and convexity, that it measures the sensitivity of the price of the bond to changes in interest rates. So because of that, now I want to test that, okay, let's say there is a change in interest rates by 200%. By how much will the price of the bond react to it? I mean, by how many percentage will the price of the bond react to this change in interest rates? So, and the formula for our basis change in basis points, can somebody help me with that? I want to write it. Who can help me? I want somebody to call it. I'm waiting. I'm waiting. No.
Is it change under convexity? Okay, is it under convexity or normal duration? You know, there are two formulas.
And let's do under. Okay, that's true. Let's do under convexity.
Under convexity, so that's okay. Let's do both for them so that they will say under duration and under convexity.
Okay, please help with the formula then.
Under duration is minus change minus duration minus d. That's your initial duration minus d.
Yeah.
Divided by 1 plus kd. 1 plus kd, yes. multiplied by your changes in basis points. By your changes in basis points, yeah.
Okay, how about you said this one is under
normal duration. This is formula for convexity under normal duration. This is the formula. I mean this is the formula for changes under normal duration, not convexity. Sorry.
Because oftentimes I think they usually use this self.
No, there is another one for convexity. This is for changes in basis point under normal duration. Yeah.
Okay.
So I will give you the second one for convexity now.
Please call it so I can type it as well.
Yeah, type changes in duration under convexity. Now, this is the formula. Minus D under convexity. Okay, it's equal to minus D divided by 1 plus KD raised to power 2. 1 plus KD raised to power 2. Raised to power 2. Put 2 there, so it will be. Yeah, multiply by your changes in basis points. Multiply by changes in basis points. Okay. Plus your convexity plus convexity, open a bracket. Changes in basis point raised to power 2. That's all. Open a bracket. Changes in basis point raised to power 2. Raised to power 2. That's all.
All right. Thanks so much.
Actually,
I'm not really familiar with the second one. That's the truth.
Now the two all over solve. Now the two. The first one you use it under normal duration, but if you want to calculate convexity, that's the formula you use. We solve everything for us in class.
Okay, see, that is a second formula. It then means if we don't have a convexity, we will not be able to use that formula.
We'll be able to use this one.
Yes. Without convexity, stick with the first formula. That's all.
I think that's just the distinguishing thing. So in a situation whereby we are given a question, and the question actually warrants us to calculate convexity, then they now ask us to calculate a change in what's equal. So should we just assume and use the second one? Would that be right?
You are not even assuming. Once just after your convexity, if you are given the changes in basis point, you are using that second formula.
All right. Okay, so for the let's do the two then. I mean, just to change the price. So for the first one, so it will then be minus D. What's our D? Our duration is 4 divided by 4 divided by 1 plus. What's our KD?
14%.
14.
Exactly. Multiply by our. So since we are assuming change base point of 200.
Let's do this one separately now.
Sorry, my router tripped off. Hello, can you hear me?
Are you? Yeah, we can hear you.
Yes, can hear you.
All right. So you said we should do something separately?
I said you should just calculate it separately. Hey, you've done this one, so you just multiply by the other one.
For our basis point, since we are doing 200, so that's equals to 200 divided by 100. So,
sorry, that second formula, is it plus or times?
Let me go back. This what case he called for me.
I think it is plus. So, or let's solve it. We know the answer we got in the class. We will confirm the answer. Let's continue.
Okay.
All right.
Which one are we talking about?
No, the second one. Let's finish the first one first. That convexity is 1 basis point is equal to 100. So it will be 1 over 100 times number of basis points they say we should do, Abi.
What do you say?
Yes, you're correct.
No, you are correct. I think you are correct. BBM, carry on. You are correct.
Yes, I'm with you. So then we'll multiply these two together.
Is it 0.2 or 0.02?
It's 200 basis points. So and 200 basis.
No, it will be in percent now.
It's not going to be in percent, KC. 200 basis points is 2%.
Because the way we actually.
So now, to take out the percentage now, it will now be 2% divided by 2.
Divided by 2 or divided by
That's
100?
what I'm saying. It's divided by 100, bro.
Sorry.
That's 0.02 now. That's 0.02.
That's what I'm saying.
0.02.
No, it's not 2%. It's 0.2%. You know, it's 200 basis points.
Okay, let's do it now. 1 divided by 100 times 200 divided by 100. That's 0.02, bro. It's 0.02. 1 is 0.02. Not 2, not 0.2, it's 2 over 100. It's 0.02.
I'm not sure if we got the right figure.
It's correct. It's correct, BBM.
It's correct. Multiply the two together. It's correct. That's your answer.
The way I normally do it, I don't even disturb myself. I just divide by 100, divide by 100.
So convert the final answer to convert the final answer to percentage. Yeah. That's the answer. To be times 100.
Please, let's note that the duration, the 4 that we did, is minus. So it's -4.
It will be minus 4. Yeah, it will be -7%.
So our final answer must be in minus.
In minus, yeah, minus.
All right. Okay. So this for this, and for the other one, check the formula. That's my system. So I think it's almost the same thing, just that we add convexity, then multiply by the changes in basis points raised to power 2. It's almost the same thing. What we've got in here, 0.9 minus 7, then we add our convexity to it. Our convexity, which is this. Okay. Multiplied by changes in basis points raised to power 2. Or would this be negative again? I doubt it though.
Which one?
I'm saying.
Let me see. Okay, sorry. For confirmation, that thing
because
both of them.
Somebody is minus.
Sorry, somebody asked if it is a. Yeah, somebody asked me something that time. I want to confirm it is plus. So somebody was checking that formula should be multiplication. Please, it is plus. So I just verify what we saw in the class. Now it's plus.
It's plus. So, BPM did now.
So this is correct, right?
This formula is the formula I gave you is 100% correct. Yeah, this is how it should be. Okay. Yeah, just check now. It's correct.
All right. So that gave us -6.68. -6.6.
Can you run me through how you did it, sir?
The convexity under the second one.
You know the second one is one. Yeah, it's minus d 1 plus kd squared. Did you do 1 plus kd squared, or you just do 1 plus kd alone?
Sincere apologies.
It's 1 plus kd. Yeah, put square there, I beg. Minus d divided by 1 plus kd squared. Minus 4. One plus 0.14 raised to power 2. Yeah.
Is this fine?
1 plus 0.14. Yeah, it's equal to enter it. That's okay. Oh, something is wrong. Oh, what you are getting looks abnormal.
Very, very abnormal.
-4.
Minus d, yes.
Divided by 1 plus 0.1. 1 plus 0.14 raised to power 2.
Yes.
Raised to power 2. Enter.
Simplifying simplifying that on its own, getting this.
Okay, let's move on. Let's move on. You might be right. So multiply it by that convexity. No, that convexity that convexity change. I mean, their basis point. The basis point will be next.
Kazim,
What is the basis
Kazim,
point?
was the change in class not 50 basis points?
And that one was 50 now, so it's different.
But this
so
200
the answer will be different. This one is 200.
But does it not seem too wide?
No, that's what I'm checking. That something is wrong. Let's do it again, bro. So I think let's leave 308 now. The next one will be change. That's basis point. What is it? Did you get for basis point? 0.02, Abby. That 8.5 one will not be. Is 0.02. Changes in basis point 0.02. 0. Where is it? Then what is that 8.51 doing? What is 8.51 doing?
That's our you said convexity. According to the formula you gave.
Sorry. I'm okay now. Minus D1 plus KD squared, that is solved. Multiply by changes in basis points. Have you done that? Have you done that? Multiply by changes in basis points. Have you? Has it been factored in?
No.
That is what I'm saying. So that changes in basis points you have not factored in. That's 0.02. You will now. Do you get it?
Yeah, I do. Oh, I think it makes sense now. I think
now,
that's what
you will now say plus. Oh, yeah, hold on. No, we are not done yet. So plus, it will not be plus, not multiply again. Plus that convexity 8 point something, Abi. 8 point something. Multiplied by changes in basis point square.
Squared, yeah. That's this.
Okay, multiply 8.5 by 0.004. Then you add it to that 6%. That's the final answer.
That's what I've done here.
No, 8.5 I multiply by 0. Okay, you now add it to 6. So what do you have as final answer now? What did you have?
5.8.
Yeah.
2.
That's the answer. It makes sense, right? That's
yes. All right. Thank you so much for this. I'm not sure I've done this second one before. I'm not sure. Okay, so that's it. So just very quickly, what is the time? 27. So let's just
I'm going to convert it to MS Word though, so that my people will understand though. How do you convert this to MS Word so that they will understand it? They will understand the steps. So
I'll have to copy it and rearrange it better. I'll copy it and rearrange it better. Yes.
You must understand the steps by fire, by force.
So assuming that.
Why are we converting to Word? Are you saying finance student doesn't understand this?
Okay, leave my people alone. Let them understand it. I beg. Leave my people alone.
I don't see reason why we should be converting to Word.
Okay, so now we are to assume if the coupon is paid semi-annually. So what will be changing in our calculation basically? First of all, our coupon, because let me go back to our question. Our coupon is quoted here. Hold on. Okay, so solve for 12%. Solve for if 12% is quoted as semi-annual. So instead of this saying that 12% are 1,000 naira bond, so they could have said 12% 1,000 naira bond paid semi-annually. Or they can say semi-annual coupon 12% 1,000. Anyway, they shall want to arrange. So far it's not quoted annually and it's been quoted semi-annually. So essentially, you should know that your coupon will be divided by 2 because semi-annually does like 6 months. So and 1 year divided by 2 gives you what your rate will be for that period. So in essence, we'll be dividing this 12 by 2, and because of that our coupon will change effectively. So for this semi-annual coupon, so then we'll have our distance to be equals to. Sorry, let me just write it out again. 100. So the coupon is 12%. So for semi-annually, so we'll be having equals to 12% divided by 2. Either want to have it, or you can calculate your 12% on 1,000 then you divide it by 2, or you can write your so with this, our cash flow can then be 6% multiplied by face value of the shares of the bond rather. So this is year 0, year 1, 2. Okay, so and also the duration of the bond now will change because now, okay, let me look for a simpler way to explain this. I think Casey already did that when it was running up the other time. The bond initially was 12% annually. So now, since they are saying that it is now if the coupon is being paid semi-annually, it implies that the term of each bond will now be 6 months, meaning that your T is no longer equals to 1 year. Your T is now equals to 6 months. So meaning that in a year, you'll be having 2 Ts. So because of that, instead of 5 years, you now be having 5 years multiplied by 2 times in a year, which is equals to 10 years. Or I don't want to use 10 years, which will be equals to 10 Ts, because you're having 10 times now. So because of that, we'll be having 1 to 10 instead of 1 to 5. Then we'll now be having 10. Yeah. This is expressive. So. Okay, so our cash flow year remains the same, and our cash flow year will be the redemption value. Sorry, I think I've made a mistake somewhere. The redemption value plus the interest in that period. So this will still remain 931. Apologies. Because this is just like if you are doing our normal capital. Yes.
That last year,
I think you are redeeming at 1,000, not 1060. Except you want to say 1 to 9 years and 1 to 90.
Yeah.
Thank you so much.
Okay.
That was an oversight. Thank you. Sorry,
Professors, who this call?
Someone wants to say something too?
No, continue. I said professor, who this call?
Thank you for calling my attention to that. Okay, so like I was saying, our DCF, so we can still use the same. Okay, I don't think we'll be able to use the same DCF since our this thing now falls around 6%. So I would suggest you use 5 and 10 this time around. Let's see, it's try and error. I may be wrong, but I mean, let's just see. Let's use 5 and 10 and see what our outcome is going to be.
Do we still need that? Why not just divide that 14 by 2 and let's move on now? Do we need that really?
Will it be the same thing?
I think so. You have already computed the effective rate, so just do the 14 by 2 now. No need to go through the stress again. Or we can try it. I'm sure you will get the same answer.
I've not tried it. Do you get?
Okay,
let me just run it.
Use it. You should get like 7%. 7%. Yeah, run it through it. Thank God for Excel.
BBM.
I'm coming on. Just a minute.
BBM, can you explain with the aid of graph?
Graph, it's about.
Can you explain it with graph?
Or you use LM curve and IS curve.
If
you cannot use it, call Solomon now.
This one, go and sleep.
That one is their own problem. They will be fine.
BBM, please.
Or you plot
the
it
next formula
on efficient frontier.
The next formula, please use classical approach in your next formula.
Mr. Governor, you'll be fine.
Use classical and
I
case.
don't know. I don't know about
during
I don't know about that.
econometrics, during econometrics, governor collects script. He write for 30 minutes. He don't be right again.
But Casey, that econometry is a very simple question, though. It's just if you don't know, you don't know. And if you know
Very
how,
simple.
it doesn't need 2 hours. It's something you can
1 hour
finish
is okay if you know how.
within 1 hour.
Yeah, very simple. That number one was a bonus if you know it. That equation on the camera form for
Exactly.
number one. It's very simple. Later, anymore. But I try my best, yeah. What's the law?
No. Okay.
How far? Okay, still on it.
Almost
Negative,
done.
positive. So, yeah.
Negative,
Do
positive.
the,
So this fine. So that's be our facts and as equals to.
I just copy this entire cell from the old one, paste it here. Let's see. Yeah, go pick it now. We'll just change your setting.
That's true. Let me see from
follow the same pattern. Yeah,
exactly.
paste it from here.
I want is a guru. Wow.
Yeah.
Let the line. No. Line here to bring it down 1 step.
No, it's correct? The same thing. Yeah, but I need to change the rates. I need to change the percentage. Yeah. So this one is 5. Okay. Then this should be 5. Then this should be 10.
Come and teach me Excel.
Yeah. Wine.
5.
You know even sabi wine. Okay.
See as they do magic. I just
say 7.26. So
okay, it's not exactly 7, Abi.
Exactly, it's not exactly 7. So it's maybe
this is just one. Is it a full question or like in the past question where you saw it? Is it a full question or a subset question?
No, I just framed it. Like I said, we did it in class, but he didn't give us some things. Then I just look for how they can complicate something very small.
If you see this question, run away, run.
Do you get? So that's just it. I just feel like these are like the possible ways they can complicate things for us. Imagine they didn't give us the YTM, or they said we should just do semi-annually or stuff. So it may throw us off balance and all. If we could use what we did in class, if we could use it to do this, then I believe we should be able to approach anyone. So that's
okay.
So this our IRR. So let's now proceed to do. So this should be very simple. Leverage this. So I'll use 7.26 specifically since I'm using Excel. So I'm now approximating. 0.26. So this would be 0.726. Six, 7, 8, 9, 10.
The cash flow will change. 60, it will be half of it. 60.
Yes.
60 and 1,000. 60 and
1060.
1060.
Yes, sir. 60. DCF. I already did for this one. Okay. -2, -3, -4, 5, -6, 7, -8, -9, -10. Okay. So this is still intact. These are PV. Our PVT. Our PVT is still intact as well. So these are PVT, and our T plus 1 is still intact. So PVT multiplied by T plus 1 is also still intact. So we have this here. So we have this as well. So with this, we can easily calculate our duration. So our duration is equals to this divided by this. So which gives us 7.6. So we can see that the whole figure actually changed. So this is our duration here. So we have a very new figure, 7.68. So we can calculate our convexity. Okay. So I think we should just, okay, yeah. Let's calculate our convexity. So what's formula for our convexity? 1 divided by 2.
1/2.
Let me just go straight. 1/2. That's equals to 1 divided by
over
PV
times 1 over K, 1 plus KD square. BBM, can you remove this your global protect?
I bet no vex so as Adiawala. 1 plus so our KD is what?
7. 7.726. 726 square.
2
times convexity.
Okay, so our convexity. Do you say convexity? May I call it PVT T plus 1? Is it the same thing as convexity?
I beg, I don't cram. Make I remember as I don't cram. Leave me.
Yes, sir.
I hope your duration is carrying negative.
No, we've not gotten to this thing.
I think the best, sir.
We've not gotten to change, Governor.
I think yeah. Be calming down. Okay, so our convexity is 33.39. 38 rather. Yes, now our duration is also high too. Our duration is also high too.
What's our duration?
Our duration is 7.68. 7.68.
Okay.
Duration is not quoted in years. Hello, did you get that?
It has to be quoted in years, Baba.
Duration is not quoted in years. I explained it. In duration, the concept behind, except maybe my understanding is wrong, but my understanding of duration and convexity.
Leave your understanding. What Olowe did in class was in years.
Okay.
I will need your understanding after MSc. But for now, it's Olowe that is going to mark my script.
All right. No problem there. So 7.68 years, what does it imply?
See, Olowe go dey solve for exam. Make we write exam, I beg. Go
Because I
understand
actually
later.
there's no
7.6
years
is 8
behind my
years
own
now.
inside the notes, Sha. And the other places I saw it, they didn't put years, Sha.
Put
So
years
that's
in
the reason.
exam.
But
No.
it's fine.
He was even asking us that how many years is that? I
Mm.
remember I told him 3 years, 9 months. Kazim said 4 years. He now said Kazim
Approximation,
is
yes.
correct. He now said Kazim is correct that we cannot have 3 years, 9 months.
That's in
It
more
is 4
solutions.
years.
You know, since how many years he has been solving it?
I think I agree. I agree with you.
But
I don't even have
that
choice.
argument alone made me to remember.
This thing is not working. Things are scattered. I was trying to. I was thinking maybe it will work. Then I won't have to type anything again, but it's not working. So, case that for the second one, I just thought we should calculate for the second change. Since we have our convexity, we should not bother calculating for the one with duration. Do you get? Okay. That's it. So we are still assuming 200, right? 200 basis points. Hello. Sorry, can anybody hear me?
Yes, we are
we
still
are.
assuming 200.
200.
726. All right, thank you. 726. Minus 2. Okay, I want to believe this is fine now. Okay, let's go. And the second part is convexity changes in basis points. Okay, convexity. So these are convexity here. And this is changes in basis points used to power 2. And like this. So these are our convexity. Sorry, our changes in basis points, changes in interest rates. So we have this. I think someone is sleeping already.
You heard the snoring, Abby.
Yes, so who could that be?
MSC people.
Governor.
Is that Casey? I think it's Casey.
He's governor. Either governor or Kazim.
No,
That's how
governor
governor
is
knows.
muted. Governor is muted. I think it's Kazim. Okay, so I think
I did hear Kazim for where?
where have you been?
You sound sleepy, Kazim.
I heard my name. Maybe what happened?
You guys are sleeping. Okay, so I think we are done. I think we are done. Okay. I think what I'll just do is just that I'll try and clean up this. I'll put everything in this Excel, then I'll clean it up. I'll arrange it properly, then send. I think that's what will happen rather than sending Microsoft.
And you can just take off the grid lines to make it look like MS Word.
Yes.
You sabi? Let me stop recording now. Let me stop recording. You sabi? Don't worry. You sabi Excel.
All right.
So
thank you.
I think
very much.
we've covered. I don't think duration and